We're going to do financial statements now, chapter 2.4. Now, do not get scared just because it says financial statements. Not many of us do accounting, right? We hire accountants, we hire the bookkeepers in our businesses, but for the exam, we need to know the fundamentals. So the good news is questions are pretty basic ones, it's pretty easy ones, as long as you know what they're asking you for. So I'll show you. First thing that they're always going to test you in exam for is your knowledge on different type of the businesses. You have to know how can you run your business and what type of business are you dealing with, right? The most commonly seen one, the one commonly used in real estate, is going to be the sole proprietorship, right? So sole proprietorship is only one owner, is only one person who pays his own taxes, and all the profits and income that coming to him, he'll be claiming out of his personal tax statements, right? So I'll explain all that stuff. The second one is called the general partnership. That's when you partner up with somebody else, and that's how you run your business. Sometimes we have limited partnership, so that means there's one general partner who's responsible for everything, and then you have some limited partners who will be basically investors in your business, and then we have the corporations. So we're going to talk about each of those type of businesses, and I will point out and show you exactly what they want you to know in the exams for each. Okay, so let's start with the first one, sole proprietorship. So the sole proprietorship, go for it. It's, when I say sole, first of all, how many people can you have in the sole proprietorship? And when I say sole, right? Sole means just one person. So this is when you get, after you pass the exam and you finish all your courses that you have to do, finally you want to register yourself as a business, which you will have to do. Why do we do this? Because we have to collect taxes, right? Only my mortgage people, it's already done for them. When they get commission, it's already deducted from them. But everybody else, we usually collect our taxes from the clients or from the commission checks, and then we have to pay them back, right? So for that reason, you have to register yourself in some way. So if you call the government and say, look, I just want to register and I want to have my GST number, a lot of times what they're going to ask you for, they're going to say, so what is your name? And as soon as you say your name, they will register that GST number under your personal name. You see what just happened? I call that a tattoo. So if you get a tattoo in here, right, with your GST number, that means you just created a sole proprietorship. Why? Because right now you and your business is one entity. Interesting, right? So you and the business is one entity. Why? Because right now you will be personally liable for everything that happens to your business. They put that GST number under your personal name. Okay, so, and it's the most common type of business that we have in real estate. So one individual cannot separate business from the personal. That's it. Just one, you put that GST right on your personal scheme. That means you're personally responsible. So liability will be unlimited to you. So what does that mean? So let's say if your business loses money and you owe money to the government, can they come after your personal stuff? Yes, they can. They can come after your personal houses, personal things, whatever you have. Why? Because you and the business right now is what? Is one thing. So for that reason, they come in after you. The owner is personally liable for all the debits included by the type of business. Credits may collect from the personal assets of the owner, so they can come after your personal stuff. Taxes. How do you pay taxes at the end of the year? So if you're the sole proprietorship, you put all those profits under your personal name, and all of those losses, you also put it under your personal name, because you and the business right now is one entity, right? So that means you're going to show those taxes, those losses, you're going to file everything under your personal tax statements, right? You're going to show them as under your personal tax statements. You have to understand that sole proprietorship type of business is not a separate entity, right? You and the business at this point is just one entity altogether. So I put here for you, itself is not subject. So sole proprietorship itself, it's not subject to income tax. So that means you're not separating the business from you. It's all you that paying the taxes, right? Profit and losses will show out of your personal tax statements. That's all you have to understand, right? Then we have the general partnership. Now, this is when people just say, look, we're brothers, let's do business together, you know? We're family, let's do business together. And that's one of the most riskiest type of businesses. Why? Because look what happens. Now, instead of calling the government and says, look, I want to have my GST number, and they say how many people, they say just me, and they put that GST number right here for you, right? You say two. Now, if it's a partnership, how many hands do you think the government will ask for? If it's you and your brother, then they will ask for 2 hands, right? One from each. And they will give you exactly identical GST number on 2 of your hands, right? So both of you guys will have exact same identical GST number. So what does that mean? That means it's not just you who will be responsible for that business, but it's also your partner will be responsible too, okay? What if that partner of yours screws up? What if he runs away? What if he borrows money and then he takes off? Who is responsible for everything that happens to the business then? Whoever is left. So basically, you're taking the liability not just on your personal name, but also for your partner's problems too, right? So basically, you're responsible for everything. So an example, I'd like to give you a question about 4 brothers. 3 of them took off, lost money, just disappeared. 1 is left. And the government said, so you owe us 400,000. And he said, no, I'll pay my share only. What do you think the government will say to him? Does he pay only his 100,000, or does he pay all 400,000? He pays for everything, right? So whoever is left, so if your partner dies and he's screwed up in some way, so whoever is left, they have unlimited liability to the whole business. Why? Because that GST number is under your personal name. So it doesn't mean that they can come after your personal stuff, your cars, houses. Yes, they can, right? So that's why the government likes this, right? They like not to separate you from your business, because this way they can come after you personally, right? So it's the same idea here. So creditors may collect the personal assets from both of the owners now. Taxes, because you put it under your personal name, it's going to be exact same as a sole proprietorship. That means your profit and losses will show up out of your personal tax statements. Hopefully that makes sense. And by itself, the general partnership is not subject to income tax. So what does that mean? It's not separated. It's not a separate type of business. Right now, you and a business is one entity, or 2 of you, right? So you create that business yourself. So you're not, the partnership itself is not going to pay separate taxes. That's what they're trying to tell you, right? The taxes will come up out of both of your accounts. Each partner must claim income losses on their personal income taxes, right? That's it. That's how it works. Let's continue. Next one, it's called limited partnership. Now, limited partnership, guys, is when let's say you have a general partner. Let's say that guy wants to have his restaurant, but he has no money. He's a good chef though, but he has no money. So what does he do? He looks for those limited partners, for people who can invest into his business. And those limited partners, guys, do you think they will have that GST number on them? Okay. No, investors, they are limited to what they can do or limited to what they can talk about or what they can do with the business. So whoever is responsible for that partnership, the general partner, right? So we can have as many general partners as you want, as many limited partners as you want. So it's not limited to how many people now, right? But the general partner is the person like that guy who will be unlimited to all of the liabilities towards the business. So he's the one that will put that tattoo on himself. So he's the one who puts that GST number. And if he puts that GST number under his personal name, is he personally responsible now for the business? Yes, he is. Why? Because he and the business right now is one entity. Does it make sense? Now, what if it's his dad who wants to invest into his business? He said, look, I'll give you money, I'll invest into you, but I don't want to do nothing with the company, and I don't want to be responsible, and I don't want any tattoos, okay? I don't want the GST number. What happens now? So his dad will be a limited partner. For the exam, you have to know what they can or what they cannot do. You know why they call them limited? Because they're limited to what they can do, okay? In Europe, they call them silent partnership. They are silent. So that means they can invest the money, but they cannot tell the general partner what to do with the business, how to run the business. They're limited only to invest the money, and that's all they can do. Liability is limited to their investment. So basically, if the general partner goes bankrupt, if his business goes bankrupt, who goes bankrupt with that business? The general partner, that guy will go, but also who else? Nobody else. Okay, all the general partners. Limited partners, they will only lose the money that they invested, right? They're only limited to their investment, and that's basically it. Limited partners have no right to take part in the day-to-day operation, so they're not allowed to work for him. They're not allowed to tell him what to do with the business. They're not allowed to do nothing. They're silent. They only invest their money. It is the general partners who runs the business, not the limited partners. Taxes. Whoever puts that tattoo on them, that's the person who will be responsible for their profit and losses to show. And of course, they will come up out of his personal tax statements. Why? Because that limited partnership is not a separate entity. It's not like it's a separate part of it that pays its own taxes. No, he pays the taxes, right? He's the one who is responsible. Limited partnership itself is not subject to income tax. So what it means, it's not, as I said, it's not a separate entity. When we talk about the corporation, we'll see it's different. But at this point, so far, all those partnership, proprietorship were all attached to a person because that person put that GC number under his personal name. Okay, so it does not file its own taxes separately. The taxes all come through that person who is responsible for that. All partners claim income loss according to their shares in the company. Okay, and they claim the income loss on their personal income taxes. So that is important for you to know. So everybody do it out of their personal tax statements. Now they also have, so limited partners also have to have the same income status, right? So when they're referring to limited partners, they always say that they also have to have the same income status. Now, what does that mean? That means if the dad wants to invest into his business, he has to do it in the same level as his business. So if his business is incorporated, the dad only can give the money through his corporation. If he is not incorporated, so he does it under his personal name, that means the dad also can put the money through personal name too. So just know that they have to be in the same income status. Okay, so the last type of business is called the corporations. And on exam, they love to test in this one because they want you to know how does the corporation works and why so many people like corporations. Now, when you do the corporation, you see that picture? You become very smart, okay? Because instead of putting that GST number under your personal name, when you call the government and they ask for your name, he says, you know what? Not interested. Not today. No tattoos for me today. I want to create my corporation. I want to create a separate entity. Now, this is where the taxes will be separated. You see how you separated yourself, your personal and your business. You'll have two separate entities right now, right? You pay your personal taxes and the corporation will pay its own taxes because it's a separate entity. It's like a fictional person that you created right now. And every time your corporation has anything to, like, let's say owes money to somebody, that somebody will come to you and says, no, talk to my corporation, talk to my hand, don't talk to me, right? You separate it, okay? So fictional entity, it's a person under the law, which is a separate legal entity, right? So you just create it, you give a different name too, right? So we usually give, I don't know, whatever the name you want to give to that corporation stuff. Never dies. So what does that mean? So if you die and you created your corporation, just because you die, the corporation will not die, right? It's like giving birth to a child. That child is not going to die because you die, right? So corporation exists until terminated by all of the shareholders. So if you have more than one shareholder in your company, they all have to close them, right? They all have to agree to close that corporation. It can't be just closed by one shareholder. Corporation could be public, it could be private. I don't know if you heard that, right? Private corporation is something that all the shares belong to you only. So that means you're not trading them in stock. It all belongs to you. And as soon as your corporation starts doing so well, like Apple and all the other ones, they go public, right? They go public, and that's where everybody else can buy those shares from them, right? Shares traded on stock exchange, that's public. Shareholders' liability is limited to their own equity. Do not own the assets. So basically, if you only have 10 shares, that's all you have, and you're only liable for that, right? You don't have to have assets. So if I want to buy Apple shares today, I don't have to own Apple computers or Apple phones, right? I don't have to have an asset of that company, but I can only have the shares. On the exam, they'll ask you that. And earn dividends and and capital gains from selling the shares. Okay, so with corporations, we deal with dividends. It's very convenient because dividends is way less taxable, and we'll teach you that a bit later too, right? But when you own the corporation pays you, right? And instead of paying yourself a salary, you can pay yourself dividends. And we do that for the tax purposes. You will pay way less taxes at the end, and you can pay yourself as much as you want, as less as you want, and you can keep a lot of money in the corporation itself. Board of directors. manages the company. So for example, they will ask you who manages the corporation, who manages your company. It's not the shareholders. Again, I can have Apple shares, but I'm not going to be a managing director of that company, right? I'm not a board of director of Apple just because I have the shares. So not the shareholders, but when you're going to apply for that corporation, they will ask you questions, right? So if it's just you, actually my question to you, in order for you to create a corporation, can it be just one person? Could that just be you? Yes, it could be, right? You don't have to have many people to create a corporation. And that means all the 100% of shares will be belonging to you, right? But then they will ask you a question, who do you want to be a board of director for your corporation? And of course, they'll put yourself, right? And then yourself, for most of them, if it's just you, then you can add your accountants for some things too, right? But as I said, board of directors, if it's something big, right, it has nothing to do with the shareholders. Liability. So you remember what I told you, because you created a separate entity, now you're going to pay your personal taxes, and your corporation, because it's a separate entity, also going to pay its own taxes. So you separated the two tax systems now. Liability limited only to the corporation. So what does that mean? If somebody wants to sue your corporation, are they coming personally to sue you? No, they're coming after your corporation. In real life, of course, just know that, you know, yes, corporation is responsible, but if you owe money to the government, they're still going to come after you personally at some point, right? So but it still separates you, right? It gives you that limited liability. So you know that nobody's coming after your personal houses, nobody's coming after your personal stuff, after your personal assets. It's only after that corporation stuff, right? A lot of people create corporation because of that. Can sue be sued? That's the usual thing. You can sue anything. Can acquire, hold, and dispose the assets, right? Of course, you can buy through your corporations, you can buy real estate. And a lot of times when you see the corporation, we'll have to check the documents to make sure that they exist, right? So that's a liability. Taxes. So what's the positive about the corporation? You separate yourself from your corporation, right? And corporation itself becomes a taxable entity. So at the end of the year, you pay your taxes for your personal profit and losses, and the corporation pays its own. So you separate yourself. Okay, has its own income status. That's what it means. You pay separate taxes for the corporation, and the corporation is subject to the income tax. So, as I said many times, you pay your own taxes, and the corporation pays its own taxes. If you look at the other three types of businesses: sole proprietorship, general partnership, limited partnership, those three type of businesses, they are not subject to income tax. They are not a separate entity. You and the partnership were together. Remember how it works? So for that reason, your other type of businesses did not have to pay taxes separately, but because the corporation is a separate entity, that's when you have to pay taxes separately for the corporation. Okay, so now a lot of students always ask, but how about the real estate corporation, right? We call it PREC, Personal Real Estate Corporation. You see quite often a lot of real estate agents out there, they'll have their billboard signs, and at the bottom it says PREC, right? That little abbreviation, Personal Real Estate Corporation stuff. Now that's a real estate personal corporation. It's different from any other corporation. So basically, the Real Estate Services Act says, look, you should not incorporate yourself as a corporation, the one I just explained you, not like this, but you can have this. Now, what's the advantages? Because you can still save some money on your income, right? So you can pay lower tax bracket, basically, you can pay less taxes at the end. But you see, the real estate personal corporation is different because the liability still stays on the licensee. So that means you still can be personally liable. So if you're going to create a real estate personal corporation, and that corporation makes mistakes, or people want to sue that corporation, they still can come after your personal stuff. And that's the problem with this one. So if they ask you what is disadvantage of having the PREC, just know that you're still personally responsible, liable for all of the losses or action related to provision of the real estate licensee, right? So that's what usually happens. Cost also could be a negative thing. Accounting costs for both establishing and maintaining the PREC, right? So that means you're going to pay a higher cost on the accounting. Requires the double of the real estate licensing fee. So if you're going to create a real estate corporation, yes, you know that you're going to be personally liable still. Yes, you know that you can save money on taxes at the end of the year because it's a way lower bracket, right? But you will pay the double fee for yourself and for your corporation. So licensing fees, right? Every 2 years when we renew the license, we have to pay that fee. So now you'll have 2 times of fees. Requires double the errors and omission insurance. And plus, you're going to pay on top of it double of the insurance. Interesting, right? But there's a positive thing. What's the positive? What's the benefits of the PREC, right? Business taxation, better business accounting and expenses. So that means you can write off now a lot of expenses through your corporation, right? All your driving, all your office fee, all your this fee, all your clothing fee, or whatever that is you have, right? All the dinners with your clients. So there's a lot of things you can write off now. Income splitting. So that's a great thing about the PREC because now you can split the income between you, your spouses, and your kids because you put them as non-voting shares that you can put into your kids and spouses, right? And it reduces your taxes in a lot of different ways. I'm not an accountant, so I'm not giving you legal advice. I'm just explaining what it's all about. Tax deferral. So that means you can defer your taxes. You can keep most of your money in the corporation, pay yourself just some dividends and pay those taxes just on the dividends. So it helps you and lower the tax rates on the corporation. It's only 12%. It's way lower than the personal, even the lowest. So that's why a lot of realtors, when they start making a lot of money in these businesses, you will see that they're all gonna convert themselves to PREC, right? They're gonna convert themselves to the real estate personal corporation, right? They need to have that because they want to save a lot of money and they want to split the income. Okay, so if you're working, let's say, buyer comes to you and they want to buy the business, so they want to buy the property through their corporation, then what happens, right? You want to make sure that you do the corporate search. You want to make sure that that company exists. And sometimes in the exam, they will ask you about the corporate search, like what are we looking for when we do that search? First of all, is the status. We want to make sure that that's an active corporation, make sure they're still in business, make sure that they exist, right? We check the address, we check the incorporation date, so when did they incorporate themselves? Because if it's a brand new corporation, that could be an issue with mortgages because they want to see that they've been in business for some time. Previous company names, if they had any names of the registered directors, the owners, so we want to see who is the name of directors in there, and when is the last annual report was filed. So we need to make sure they actually file the annual reports, because if they don't do that, then the corporation will be inactive, right? So something that we have to check for. Okay, let's do a couple of questions on what we just learned, and that's fun. So all of you guys will have quite a lot of questions on different type of businesses. They're always going to test you on corporation, sole proprietorship, and all the things. So you never know which one is going to be your question, but I'll give you a couple. So true and false on the back of this chapter notes, please. Question 1. A sole proprietorship does not file its taxes separately from the principal. It's true or false? The sole proprietorship, the number you put under your name, okay, does not file its taxes separately from the principal. Now that is true because you are one entity, so you don't separate yourself from the business, right? So you have to pay it under your personal name. Okay. Question 2. A sole proprietorship is the least common small business ownership model in service industries and has a lifespan that can exceed that is its own owner. Now, is that true? Okay. It's the least common small business thing. This is the most common one. This is where people start with. They always, for some reason, start with a sole proprietorship because it doesn't cost you anything to start, right? It's basically free, but yes, you are liable, and it cannot exceed the life of the owner, because if you die, your business is attached to you. It will die with you. It's only a corporation that never dies. Okay. Question 3. Limited partnership. So limited, remember the dad who wants to invest money into his son's business? Have liability to creditors, which is limited to their amount of money that they have invested in their business. Is that true? Yes, it is, because they are limited to the amount of money they put in, and that's all they can do. They're just investors. Question 4. Limited partners, because they are not involved in the day-to-day operation, which is true, of the business, are taxed at a lower rate than the general partners with respect to dividends distribution. Is that true? Do you think they're going to have a different income status? They will have exactly the same income status. So it says limited partner liability limited to what they have invested. Okay. Partner earnings tax on their personal tax rates, just like general partners. So everybody pays exact same tax, not at a lower rate. And the dividends paid to shareholders, not paid to the partners in partnership. Okay, so that's kind of a clue for you. Next one, question 5. The limited partners can be actively engaged in managing the business without any consequence to their partnership status. Now, would that be a true statement now? Can they actively engage in the business? Can they work? Can that dad says, you know what, I'll work at your restaurant and I'll wash your dishes. He's not allowed to, right? Because they're not allowed to do any day-to-day operations in the business. So for that reason, it becomes a false statement. And if they do that, then they will lose that limited partnership status and they will become a general partner themselves. So that's not a good way to do that. Okay. Question 6. Which of the following is a characteristic of the corporations? So now they're referring to the corporations. A corporation cannot be sued. Is that true? You can sue anything, right? So that's false. The corporation whose shares are traded on stock exchange is referred to a private company. Now, is that true? I'll show you the answer. That is false, because it's not private. It should be public one. A corporation is subject to the corporate dividend, dividend tax instead of the income tax. Okay. Also false. A corporation is a separate legal entity is what they're aiming for, right? So that becomes a true statement. Okay, so hopefully you got an idea about the different type of businesses. Now, the other questions that they will test you on is going to be the 6 type of accounting principles. So this is something to do with accounting. The good news, we don't have to do math on the accounting in here. Okay, we don't do that. You just have to recognize the principles and say, okay, if I'm getting the commission, under which principle am I going to put this money in? If I have an expenses, under which principle this money going to go in? Right? So that's what they want you to understand. They are pretty straightforward. Don't be scared of them. So let's start with the first one, cost. They call it an exam the cost, or they call it the historic cost principle, which means exactly the same thing. So when I say cost to you, think of it as something that you paid for. Okay, that is a cost to you. So if I was your accountant and you come to me and I say, okay, so tell me, you bought a car for your real estate business, and I'm asking you, what do you think of the amounts I should add to my book as a cost to you? You see how simple that is, right? It's a cost principle, the historic cost principle. So ICBC insurable value is 60,000. Listed price was 68,000, but you negotiated and you paid 62,000. Which amount would you put it as a cost to you? Is what you paid for. That makes sense, right? So what you paid for. So record the amount of you paid for at the time of a purchase, right? So when they refer to purchases, right? You're buying something, then you think of it, okay, that is a cost to my business, and I will add it onto this accounting principle. Simple, right? Next one. Then we have the revenue recognition principle. So when I ask you, again, I'm your accountant, you come to me and I say, so how much commission did you make this month? Okay? What's the revenue? Did you make any bonuses? Did any money came to you? Did you put some money into your pocket for your business? And whatever you receive, that's called the revenue recognition principle. And I need to add that to my books. But this is what they trick you on. So first of all, on the exam, if we talk about commissions, if we talk about any money coming to you, right? Then you think of that revenue recognition principle. That's your keywords, okay? But what's important is this, and this is how they trick most of the people, but not you, okay? Revenue should be recognized, that is put into the books. It's when it's earned or when it's received. So look at that story so you understand that better. So Joe has helped to sell the property and gets 10,000 commission, okay? December 2021, subject clauses are removed and deposit is paid. But then January 15th of 2022, the completion date, and that's when you get paid. So let me just explain it. In real life, okay, in real estate, we have a very different ways of getting paid. when our clients, they remove the subject. So subject to financing, subject to inspection, subject to title search, whatever they want to check on before they buy the property. So that's called the subject clauses. And when the client is satisfied with the property and he loves it and he wants to buy it, he gets committed to buy it, he removes those subject clauses. Now, what happens in that date? So let's say if somebody removed the subject on December 1st of 2021, we go celebrate. We go celebrate, we get drunk in the offices, you'll see all those bottles and drunk agents. Why do we do that? Because we know we earned the commission. Just because they remove the subject, we earn the commission. But what are we waiting for? So while we're getting drunk in the office right now, do we have any money in the pocket at this point? Absolutely nothing. Why? Because we're waiting for that completion date. Completion is when they exchange the money for the title. So buyer gets the title, seller gets the money, and we get the commission. Mortgage people, real estate people, we get commission on that specific date, right? On the completion date. That's when we really feel the good stuff. Okay, but look what happens. If I was your accountant and you come to me and say, look, Yana, this is what happened to me. When do you think I'm going to put that as a sale of which year? You see, revenue recognition. Where would I recognize that as a revenue? Which year do you think? It's when it's earned, not when it's received. And when did you earn it? You earn it in 2021 when they removed the subjects, but you received the money in 2022. So I'll put it as a revenue for you for which year? Of 2021, that you have to pay taxes on that year. So basically you have to pay taxes before you get the money, right? But that's how they want you to know for the exams, is when it's earned, not when it's received. Okay, next one. Then we have a matching principle. Every time when you say the word matching, I want you to think of the expenses. Okay, that's it. Matching refers to the expenses. So if you come to me and I'm your accountant, what would I ask for? I say, okay, give me all your bills, give me all of your expenses. I want to see them because I need to add them to my books. We already talked about the revenues. I put them, let's say this sale, I put it as a sale of 2021 because you earn them on 2021, right? Not on 2022. But in this case, look what happens here. The expenses and revenues are matching. They're matching. And that's why they call it matching. Expenses matching up to the revenues. Expenses should be recognized and deducted in the same period as the revenues that generated. Recognized when they incurred, not when it's paid. So it's never about when you get paid or when you have to pay for things. It's when they give you that receipt. So let's say if they give you a receipt, you bought $500 of the advertisement in January. This $500 is not due till March, and he will pay then. When would I add it to my books as an accountant? What would I put that in? If I have to match it up to the revenues, I will put it in the same way, okay? It's when it's incurred. So on January, that's when it's incurred, right? And March is when he has to pay for that. So I will add it to the revenue. I'm matching up to the revenues. I will add it when it's incurred. So I'm going to add it when? In January, not in March, okay? Because January, I'll put it because invoice was made for the January, not due till March. It doesn't really matter to me, but I will add it in the same way as my revenues. Okay, revenues when it's earned, not when it's received. Same thing here, when it's incurred, not when I have to pay for things. Okay, so I'll put it as an expense of January. Then we have an objectivity principle. And objectivity, it's a very straightforward principle. It says, whatever you're going to bring to me as an accountant, I want to make sure that it's objective. I want to make sure there's a proof to that. So if I look at your statements and I can see that you have like a lot of Cactus Club in there and you have a lot of restaurants, and I will ask you, what is that for? And he says, oh yeah, that's just clients, meeting the clients and taking them for dinners. I'm like, great. Make it objective. How would you make it objective? What would I ask from you? The receipts, right? I want to see those receipts, so you have to be proven to me. So all the amounts must be objective and verifiable, right? By the third party like government. If they come and they want to audit you, just make sure that you have all the receipts. But for the exams, this is what they want. It's closely aligned to the cost principle. Now, what's the cost? Cost is what you paid for. Remember that? So how much did Joe put in his books when he bought a car? Is what he paid for that car, right? So closely aligned to the cost principle, because the best way to ensure the objectivity in accounting transaction is to record the amount of the consideration given up to the day of the transaction. So basically, whatever you paid for, that's what I'm going to put in my books. And I want to make sure that you have some type of proof to that. And that's basically what they try to tell you, right? That's just to show you the cost principle. Okay, the consistency principle, it's even better. They're trying to tell you that if you adopt these principles, as an accountant, I have to be consistent. As my client, you have to be consistent. So every single following year, it should be the same system. You should follow the same stuff. Once the principle is adopted, it should be used in all of the future years, right? Don't try to change them. Don't try to adapt them. The changes to the accounting principle should only be made where the changes result in providing more relevant and useful information to the user of the financial statements. So the only time you do any changes if they are more relevant or they're more useful. Otherwise, you don't change it. You stick to all of the same principle. Be consistent. Next one. This is a fun one. People have a hard time with this, but it's the easiest one out of all of them. Materiality principle. When I say materiality principle, they're talking about materiality means anything to do with, like, it's kind of like an expense, but it's different from the expense, okay? We use the matching principle for the real expenses. So when you have advertisement expense, I'll add it towards the matching principle, right? So that's how I'm going to do. It is an exception to matching principles. So that means it is an exception how you're going to put those expenses in your books now. So what I'm trying to say is this. If you have something tiny, let's say if I look at my books and I have some differences in 0.2 cents, $1 difference, something small, something that is insignificant, right? Something that is not really big thing to me. So I'm not going to put that 0.2 cents as an expense and create a separate thing. I'm just not going to do this. I'm just going to wipe it off, basically. And that's what it stands for. So it is exception to matching principle. So it's not a real expense. That's what they're trying to tell you. The financial reports only have to include information that will be significant, which is material, to the users. So if it's a significant expense, then yes, I'll use the matching principle. If it's insignificant, 0.2 cents, I'm not going to take those 2 cents and try to add them to my books. I'll just wipe it off, right? Based on the materiality principle. So for the exam, just know it is an exception and it's not a matching principle. It's opposite from the matching principle because it's not a real expense. I put it here for you, right? It's so tiny that it doesn't really matter. Okay, question 7, true and false statements. To conform to the cost principle, it is important to record the asset at what might be considered its a fair market value instead of what the enterprise paid for. Would you add to your books what the real market value, or would you put into the books what it's actually paid for? Of course, you're going to put what it's paid for. For that reason, that's a false statement. You can't just put something that is just because it's worth that much. You put that much into the books. Okay, doesn't make sense. Matching principle requires that expenses are always recorded when they are paid, which is not necessary when they were incurred. I've seen sometimes always as a true statement, especially when it comes to accounting principles. So that's not the keyword that you're looking for. But when are you putting the expenses into your books? It's not when you pay, it's when it's incurred. For that reason, it becomes a false statement. It's opposite, right? It's when it's incurred, you put it in the books. You remember the matching principle? If my invoice came for January, but I don't have to pay it till March, I'm still going to put it as an expense of January when it's incurred. Question 9. The revenue recognition principle states that a business enterprise should recognize revenue when it's earned, not necessarily when the cash is received. When it's earned, not when it's received. Now, that is true, right? You put it into the books when you earn it. Remember that commission? You put it in 2021 year, not 2022, because you earn it when they remove the subject clauses. Question 10. True or false? Consistency principle holds that changes to accounting principles should only be made when the change results in providing more relevant and useful information to the user of the financial statements. That is the true statements. We talked about this. Usually you should not do any changes, but if you do changes, it's only when it's more relevant, right? Or more useful information provided. Okay, question 11. The consistency principle holds that once the business enterprise adopts one general accounting principle from the number of the alternatives, the enterprise should not follow the same principle in subsequent years. Don't look at that. Okay, should not follow the same principle in the subsequent years. Is that true or false? That's definitely false. Why? Because you should follow. That's the whole idea of the consistency principle. So you should follow all the other principles, right? So it's definitely a false statement. Next one, question 12. The materiality principle is the same as the matching principle. And I can just stop right here. Because what did we say? The first thing we said that are opposite. They're different ones, right? The materiality is not, it's something insignificant. When it comes to matching, it's a totally different thing, right? So for that reason, that's a false statement. How is it so far? Right? So that's what I mean. They're going to test you back and forth on those principles. So now you have to know what is a fiscal year. Fiscal year is something that cannot be changed at will. Now, when they say it cannot be changed at will, they're referring to all the proprietorship and partnerships, but it's not applicable to the corporation. So on the exam, if they don't specify, they just say fiscal year cannot be changed at will. They refer, and that is a true statement, and they're referring to all different type of businesses except the corporation. With corporation, you have the rights, okay, to change it, but the tax year cannot be longer than 53 weeks. So basically they're saying that when you open the corporation, the tax year doesn't have to be always December 31st. The end date doesn't have to be. You can choose your own date, but as soon as that year is not longer than 53 weeks, then that's okay. Okay, so that's what they're referring to. So for the exam, just know when they say fiscal year, when they just say cannot be changed at will, that's a true statement because they're referring to general type of businesses, but the corporation tax year could be changed, right? But cannot be longer than 53 weeks to like that statement. Just know it as is. So now we're going to talk about the balance sheets and income statements. Now, good news is no math on this. You don't have to do any math in here, but you have to understand the difference between those two statements and when do we do those statements. So balance sheets on the exam, they call them financial statements. Sometimes they call them the assets and the liability statements. So whatever they call the different names, it all means the exact same thing. For you, think of it this way. If I'm your accountant and you come to me and I say, look, if I want to show you how you progress during the year, then let's look at the balance sheet. Let's look at the assets, look at your liability sheet, right? Because I'm going to show you the picture of you on a monthly basis. This month you look happy, this month you look sad, this month you look fat. I don't know, right? So that's what it's for, right? So what is the assets? So when I say the assets, it's something that belongs to you. You own it, right? It's yours. For the exams, they want you to know that we have two different types of assets. We have the current assets and we have a non-current assets. And that's where the questions usually come from because they want you to know the difference between those two types of assets. So how do you know which one is what? Anything to do with the non-current. Let's talk about the non-current stuff first. Non-current is something that will stay with you for a while. So when you buy something big, if you buy yourself a car, you buy yourself a land, you buy yourself a building, you buy yourself a house, those assets, they belong to you and you're planning to keep them for longer than a year, I hope. Right? So that's what makes it a non-current asset. Now, when it comes to the current asset, it's something that gives you cash. So if you sell it right now, it gives you cash, right? So anything that puts in your pocket now, right? That, like, let's say if I have a cookie shop, those cookies are the current asset because I'm not planning to keep them for longer than a year, right? So I'm hoping I'm going to sell them and get the cash for that, right? But those trades and the cash register and the location itself, that becomes a non-current asset because they're going to stay with the business for a while, right? So that's how you have to think of it. So the asset is something that you have. Now, how do you know if it's an asset? How do you know if it's not a liability? If it's coming to you, right? If it's receivable, then that becomes an asset, right? If it's already being paid for something, that becomes an asset. Because I know a lot of people say, but okay, so cash, it makes sense. Okay, it comes and goes. It's not like you're going to keep the cash in your pocket for longer than a year. Good luck with that. Right? Accounts receivable, that makes sense. It's an asset that's coming to you. But the expenses, a lot of people look at the word and says, oh, that should be a liability. But no. It's been already prepaid. So if you paid already for something, that becomes an asset to you. So look at the wordings. Don't look at what the item is. So if it's paid, if it's receivable, then that becomes an asset, right? Inventories, an example like that word. So again, everything that brings you cash, that becomes an asset. And that is a current asset. Why is it current? Because it will get you cash within the year, right? That's what that is. Non-current is something that's large. For the exams, the easy way to remember is everything to do with non-current. If it's a car, building, land, house, non-current, everything else will be current. Okay, liability is the same thing, something that you owe. So as an accountant, what would I do? I'm going to look at all your assets. I will minus all your liabilities. Yes, you have a house, but you have a mortgage, right? So that's minus out of it to show me your owner's equity. I have to see it, right? So same idea. We have a current liabilities, non-current liability. Non-current is something that you cannot pay off within the year, right? So if it's a mortgage, right? If it's a car loan payable, then that's a non-current liability because you will have to take some time before you pay it off. Makes sense, right? So that's kind of a large amount. Current is something that should be paid, and anything to do with government. If they say taxes, it has to be current liability because government wants to be paid off now. They're not going to wait until tomorrow, okay? And then next year. So payable, that's what makes it a liability because you still have to pay for that. So accounts payable, wages payable, taxes payable, tenants deposits, right? That's also a liability because you have to pay for that at some point. Now, what if I say wages paid? If I just change that word payable to paid, what would happen then? If it's payable, yeah, that is a current liability. But if I say wages paid, what would that become? Then that becomes a current asset because you already paid for that. So just watch how they say the words to you. Now, so what do you do on the balance sheet? You look at the assets, you minus the liability, that gives you the owner's equity. If it's a personal, so if it's not a corporation, so if it's a person that puts the business under his personal name, you will see his name in here and you will see his equity, right? It will calculate the equity for you. But what if that was a corporation? What if that's a corporation balance sheet? So then the only difference that you have to understand in here is that instead of the person's name, you will see that as a shares authorized and issued by, right? So you will see the shareholders, but not their names, right? No owner shareholders' names will show up on the corporation balance sheet. And that's all you have to know. Okay, question 13. Which of the following items will not fund on the balance sheets of the corporation? Just give you the answer. But everything else will be except the names of the shareholders, right? You will never see their name on it. Question 14. On the balance sheet, inventories would classify as what? Inventories gives you cash, right? Cash is something that puts the money into your pockets. That is an asset, and that has to be a current asset, right? It's not a long-term item thing. Next one. Which of the following is a liability under the financial statements? You see how they call financial statements a liability? So what would that be? People look at option 3 and they look at option 4 and option 1. It says, because it says both, maybe that also a liability. What do you think? Did you choose option 3 or option 4? I hope you chose option number 3. Because option 4 talks about 1 being a liability. You see, depreciation expense is not a liability. It's an expense. And we'll talk about this later in the income statements. Expense is when your car depreciates, right? It's something done at the end of the year. But here we're taking a picture of you and we just say what's something that you owe. Salaries payable, something you still have to pay. That's definitely a current liability. Next one, question 16. Current assets of the financial statements of the business include what? What are they looking for? They're looking for the current assets. Something that comes and goes within the year. Is that a land? Land is a non-current asset. They're looking for the current asset, so that should be rents receivable. Why is it the current asset? Because it's coming to you, right? So that's why it's an asset. Good job. Okay, question 17. How would prepaid expenses and income taxes payable be classified on the balance sheet? Okay, so first we have to look at the prepaid expenses. Don't look at the word expenses, but if it's paid, that is a current asset. Good job. And if I say taxes payable, that's a current liability. So it should be option number 2. How about this? Question 18. How would you enter wages payable and accounts receivable? How would you specify that on the balance sheets? Wages payable is the current liabilities and accounts receivable is the current asset. Beautiful, good job. Okay, so the next statement that you have to know is the income statement. Now, income statement is where I make a video of you for the full year. This is when I don't look just at your assets and liability per monthly statements. I look at all of the revenues for the full year. I look at all of the expenses that accumulated for the full year too, right? And then I'll figure out how much you made from the sale, right? So I'm going to look at your net income. So revenues minus the expenses gives you the net income, how much you made. So think of the revenue, something that coming to you, your commissions for the whole year, your interest, your services, direct revenue, whatever the money you made, right? That comes to you. Expenses, anything you paid for. And as we talked about, your office supplies, advertisement, interest, and also the depreciation is also as an expense. And we're going to talk about this in a minute, but this is what you have to understand. Depreciation is not a liability. It's not something that you owe. It's an expense to you. And it's something will be right off at the end of the year. And that will give you your income. So for the exams, they want you to know that in the statements of a cash flow, okay, changes in depreciation expense are recorded under the operating activities. So when they're talking about depreciation expenses, it's an operating activities. There's an investment activities, there's all different activities, but operating activities, it's on a yearly basis. That's what they're referring to. So let's talk about the depreciation. On the exam, a lot of times they will ask you for a definition on this. They will ask you, so what is the depreciation expense itself? So if I bought a car for $60,000 and I use that car for over 5 years, my car is not going to be worth $60,000 anymore. It's going to be less than this. So if they ask you for a definition, it's a method used to allocate the cost of the assets over time. So the cost of my car over time, that's all they want you to know. So if they ask you for a definition, that's what they're looking for. We also have to know that we have two different types of depreciation methods. One of them is tax deductible and one of them is not. So straight line method, straight line depreciation method, this is when you can write off that car on a yearly basis and the amount will be exactly the same every single year, right? Not a tax deductible method. Then we have a capital cost allowance method, CCA method. This is a government method. So basically they give you a tax bracket and they say for a building, you can write off 4%. For a car, you can write off 30%. So they tell you every single year how much you can write off things. Now, this is a tax deductible method. I'll show you what I mean by this. This is just an example. You don't need to know this stuff. As you see, there's no math in here. Just people ask this question all the time, so we just have to explain it to you. So CCA is something governed by the government, and they said that is a tax deductible method. So if I want to write off my car, let's say depreciation for that car for the first year is $2,000. And I know it's deductible method, so I can deduct that $2,000 from my taxable income before I calculate my taxes. So if my income was $100,000, I will deduct the $2,000 and I'll pay taxes on $98,000. Simple math, right? But if it's a straight lane method, depreciation method, where every single year I can write off the same amount of for my car, that is not a tax deductible method. So I have the $2,000 deduction. I cannot deduct this amount from my taxable income. I actually have to add that $2,000 to my income to pay taxes on it. So earning will be $100,000. I would have to add the $2,000 and pay $102,000 and taxes on that. So that's just, don't worry about this part. That's for people who have extra questions about what is tax deduct, why is it this and that. But you just have to know that we use the two methods for the exams. You also have to know what is a book value. When somebody says a book value, it's not a blue book value. It's not the one that we apply for the cars, but it's just a good example for you. Because if I was looking for the car, how do I know how much the car is worth? I would look to see the year of the car, and then I will know how much the car is worth this year. So for the exam, if they ask you what is a book value, it's the original cost, how much you paid for, minus depreciation up to this date. So if I was looking at your house value, well, let's say the car, I paid $20,000 for the car. Depreciation up to this date is $3,000. So the book value of the car is $17,000. That means it's worth right now $17,000. So when they say book value, how much is it worth right now? Right? Cost minus depreciation up to this date. So what we're going to do right now, we're going to do a little bit of math. Only for my property management and startup people, you guys can stop the videos right now and go home. You're done. This is something applies only for my real estate and mortgage students. They will ask you for math to do the calculation on this straight line depreciation method. So what is a straight line method? Not tax deductible method, but something you can write off on a yearly basis. And what you can write off will be exactly the same for every single year. So let me explain you what I mean by this. So let's say you bought a car, it's worth $20,000. He said, I can use that car for 10 years. So when they're referring to economic life, that's how long you can use that for, how much you think is the value good for. And then the salvage value is how much do you think you can sell it for after you stop using, right? So what you do when they say using the straight line method, and on exam they will specify, they say using the straight line method, how much depreciation could be. And what you do, you have to get the cost, right? How much you paid for, so in this case it's gonna be $20,000, okay? Minus the salvage value, how much do you think you can sell it for after you stop using it? And then you divide it by the lifetime. So it tells you that every single year for 10 years, you can write off $1,800, $1,800, $1,800, right? That's how you can depreciate the car in one way. So using the straight line method. For the exam, just know that whatever you do, you can depreciate the car, you can depreciate the house, you can depreciate the building, but the land will never depreciate, ever. So you don't touch depreciations on the land at all, right? Land is worth what it's worth, right? So that's one of the clues that I'm giving you. Okay, we're gonna do a couple of questions. We'll see how simple they are. Question 19. A company has just bought a truck for $22,500. It's expected that the truck can be sold for $3,015 years from now on. The current market value of the vehicle is 27. Doesn't matter what's current market value, not really. And what is your keyword? They say using the straight line method. You see that keyword? So when they say using the straight line method, the formula should come to your mind. And what is the formula we use? The cost minus the salvage divided by the life. That formula, right? The cost minus the salvage, how much you think you can sell it for, and divided by the lifetime. So if I'll go back in the question, we need to find out the cost. Which one is the cost? Is that 22.5 or is that 27? Is that a market value or how much they paid for? It's what they paid for, right? So you're gonna use the 22.5. You're gonna minus the salvage. They're gonna sell it for $3,000 after 15 years, so minus 3,000, and then you're gonna divide it by 15, right? And that will give you that $1,300. And that means every single year you can write off that $1,300. Next one, question 20. Now it gets a bit more complicated. Your job on the exam to always look for the keywords. Now what do we have keyword? Straight line depreciation method. You're looking for that. If you see this, you know your formula. The cost minus the salvage divided by the life. So let's find the cost in here. Fannie Mac Ltd purchased a small commercial building for $225,000, of which $100,000 was the value of the land. And I'll stop you. Does the land ever depreciate? No, right? So what it depreciates is the building. So if I take 225 minus 100,000, that gives me my building cost. So the building cost will be how much? 125, right? So 125,000. And it says the Fannie, the company president, felt this was an excellent deal because she would have been willing to pay as much as 250. It doesn't really matter to us. 1 year later, Fannie sold the property for 300,000. All that extra information just to confuse you. We don't need. We need just to get the cost, the salvage, and the life. So we already have the cost, right? The cost was 125, right? So we took the cost of the whatever they pay for, minus the land, that gives you the cost of the building. Then it says that the economic expected life was 10 years. We need that number, and establish the salvage value of 25,000 using the straight line method. That's it. So cost minus the salvage divided by 10, that gives us $10,000 for each year for 10 years. So option number 1 is the answer. Question 21. A company pays $97,835 for the asset of which the Income Tax Act allows capital cost allowance of 5%. So they put that CCA in here. Per year, the asset is expected to have a useful life of 25 years and will have no salvage value at the end of this time. So no salvage value. Calculate the depreciation expense for the accounting purposes for this asset third year if the accountant chooses to use the straight line depreciation method. So straight line method. Because they use the word straight line, would we ever use the capital cost allowance? Now, what is the capital cost allowance? And straight line is two different methods. So if they say using the straight line, you're going to say forget about the capital cost allowance because that does not fit in our formula. And because they're asking you for the third year, would that really matter? They do this on purpose all the time. Third year, seventh year, it doesn't matter because what does the straight line stands for? That every single year it will be exactly the same amount. So they're trying to trick you. So just cross off those two things. Know that they're just trying to trick you out. And here, all we need is pull up three numbers: the cost, the salvage, and the life. We have the cost of 97,000. We have no salvage in here, and then we have a life of 25 years. So that's what you do. So 97,000 divided by 25 years will give you 39,1340. Right? So that's how much they can write off for 25 years. Every single year will be the same amount over and over. I'm losing my voice. So the last method, remember the capital cost allowance method, CCA? As I said, everything is given to you by class, right? So in this case, you have to know these two rules that comes with this method. That is a tax deductible method. Government tells you exactly how much you can write off for each item. But the rules that you have to know that in the last year of that item, so if you use the car up to this year, it doesn't matter when you sold it in January or December, but in the last year, you cannot write off any of that depreciation for that year. Last year, it does not count. But in the first year rule, so if you just bought it just right now this year, you can only write off half of the rate that's allowable by the CCA. So that means, for example, if the car class 10 gives you 30% CCA rate, which is a real one in real life, right? In the question, all that information will be given to you. So if they say the rate is 30%, that means in the first year, you can only write off half of it, which is how much, okay? First year depreciation will be only 3,000. Why? Because it's only 30% from that, right? So the cost is 20,000. So 20,000 times it by 15, half of that rate gives you that. Gives you that 15%. So in the first year, it's only half of the CCA. In the last year, nothing. So that's the rules you have to know. And then it goes the second year, the third year, the fourth year, and it goes on, right? So how do you know if it's the second year? What do you do now? So if the car was costing you 20,000 in the first year, you took 15% from that. Now in the second year, the year book value of that car will be 17,000 now. And now what do you do in the second year? Now you can write off the whole 30% from that, right? So you can take 17,000 times it by 30%. So CCA could be, you can write off that much, right? So now the book value of the car for the third year will be 11,000, and it goes on, and it goes on. And if it's in the last year that you sell in the car, then you cannot write off any CCA at all, right? So that's what they want you to know. Question 22. Which of the following statements regarding the capital cost allowance is false? So now, first of all, who created the capital cost allowance method? Through the government. So if I look at option 4, it says CCA percentage rate is determined by the Canada Revenue Agency. Now, is that true? That is true because that's exactly where it's coming from. They ask you for the full statement, okay? Only 1/2 of the maximum allowance CCA may be claimed in the asset in the first year of the asset purchased. Even though it says only, but it's only half of the percentage. That is true statement 2, right? No CCA may be claimed in the year of the asset disposal in the last year. That's also true. So far, everything is true. So if I use my method of elimination, I know option 3 is false. But why is it false? How did we calculate that CCA method? Okay, what did we do? We took the cost times it by the CCA, right? That's what we did. But in this question, they say the maximum CCA is given here is equal to the depreciation expense multiplied by CCA. It's not a depreciation, it's the cost of that asset times it by the CCA, right? So because of this word depreciation expense, that's what makes it false. It should be the cost times it by CCA percentage. Okay, question 23. ABC Inc. paid $155,000 for the asset on which the Income Tax Act allows capital cost allowance. The asset was purchased 5 years ago and it will be disposed at the end of this year. So it will be sold this year. How much CCA will be claimed by this company at the end of this year? So how much can you write off in this year? Nothing, right? The rule is in the year of disposal, you cannot write off anything. Good job. So that's it. We finished this chapter. Hopefully it wasn't too bad for you. As you see, it's not as scary as you thought, financial statements. But just know that you will have definitely math on the straight line method. When they will say straight line, they'll try to trick you. Just know your stuff. Know your foundations about the accounting principles, and definitely know the types of businesses. So that's kind of the foundational questions from this chapter. Okay? We'll see you in the next one.